Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Welcome back. It's Sarah Larby. You are listening to Where Should I Invest? I have another great guest today. You might have heard him on a past episode, the one and only Marcin Drozdz, who is a really successful multifamily real estate investor, has acquired a lot and also has been able to get really, really good at getting money and raising funds and raising money to do a lot of these deals. And so we talk about how to invest in large multifamily properties in the US specifically. And he does a lot of business in Memphis, Tennessee. We talk about VTBs, how to close on large deals, how to take a distressed property and make it bankable, and so many more things. So I hope you guys enjoyed today's podcast. Don't forget to leave a rating and review. And also October 6th, we have a live event in Markham. If you are interested in attending a live real estate event with food and drinks and comedy and music and so much more, send me an email, sarah@sarahlarby.com. I hope you guys enjoy the podcast. Marcin, welcome back to the show. How are you?
I'm great. Thanks for having me again.
Good. Yeah, it's been a while. I want to say probably a couple years since you've been on the podcast last, and I wanted to reach out to you again and bring you back in because you've done some big deals since, and I definitely want to dissect them and hear what you've been up to since then. But folks listening to this, I would suggest that you go back to listen to Marcin's first episode. But just for people, just to catch them up, can you just give us a bit of a 30,000 foot view on what you do when it comes to real estate investing?
Sure. I'd love to. Buy stuff, fix it, refinance it, do it again.
So essentially the BRRRR strategy.
It's BRRRR, big BRRRR. We focus on U.S. multifamily, workforce housing.
Awesome. All right. So now you are Canadian.
Yes.
You normally reside in Ontario and you are buying in the US. And you're buying big buildings in the US. What are some things that you have potentially struggled with as a Canadian buying into the US that we should be aware of?
Well, the first question is why.
Sure. Let's do that.
The first question is why. I mean, people, I've been guilty of it before myself, Sarah, is where you get comfortable investing in your own backyard, wherever it's Toronto, Winnipeg, Edmonton, wherever you're investing, it's easy to kind of have the blinders on and look where you live. So, I've lived all over Canada, and like yourself, I've done a lot of different deals, residential, commercial, multifam. And a few years ago, actually back in 2010, I'd started in US when I worked with a private equity firm, and we were buying multifamily back then in Phoenix. And like yourself, I was always like, why US? Why not Canada? We're so much friendlier here. We've got, so much more, there's opportunity here. Why, is the grass really greener somewhere else? And for me, it was, Canada pricing, real estate, I'm sure I've listened to some of your podcasts. You've had people on here, and prices are what they are. Now the U.S. It's interesting because if you tell me about a tertiary market here in Canada, you're probably thinking like Timmins or like a 50,000, 80,000, Prince Albert, small town like that. If you're talking tertiary market or secondary market in the U.S., it's 1 million people. So it's a totally different
big
scale.
Difference, yeah.
It's a big scale. So, from a US perspective, when they talk about secondary, tertiary markets, to us as Canadians, that is a Calgary, that is a Toronto, that is a, fill in the blank, Mississauga, right? So because of that, there's this opportunity in the US when you combine the fact that the big guys don't look at towns that are 1 million people, which to you and me is crazy. And you combine that with the fact that you're able to buy apartment buildings in a lot of these towns for anywhere from $20,000 to $50,000 a door, where in Canada, you can't even buy a parking spot for 25 grand anymore. that's a very compelling conversation to start things off. Now, obviously, you have to educate people. Some of our partners, even myself, when we went down there and wrote the checks, you wanted to make sure people were familiar. But I think out of the gate, that was the biggest question. Why?
Yeah, absolutely. I mean, I've had a few people on the show recently that have invested in the US, and I mean, like you said, it doesn't always have to be our own backyard. I think there's pros and cons to go, going both routes, and diversification is definitely not a bad idea. Especially with so much unknown, for the future. So where in the US are you currently investing right now?
So we drew a map around a few major hubs, a few MSAs that were between 1 and 1.5 million people. And the market we were most excited about was Memphis, Tennessee. Memphis, the birthplace of Elvis. Memphis, pork and ribs, beans, potatoes. It's a very blue collar town. And, even pre-COVID, it was a great place to be. And now post-COVID, with so many people shifting to, buying things with a little button on their screen, logistics are even more important. So, Memphis has FedEx's global world headquarters is in Memphis. Nike built an additional 2 million square feet in Memphis. Over a third of their sales now, post-COVID, are direct to consumers. So people aren't going to Foot Locker anymore to buy their shoes. They're buying directly online. And that has a massive, change. Amazon built a facility there. Google built their first American, I'm going to confuse this, but they have a technical facility for customer service. Their first one that they built in the US. They actually built it just south of Memphis, literally 20, 30 miles down. So even pre-COVID, there were a lot of reasons, but now post-COVID, with the infrastructure and the delivery and warehousing and logistics becoming so much more important. Last time I was down there, you couldn't turn the TV on without an ad for a job. And this is post-COVID.
Yeah, absolutely. So are you going to Memphis and traveling to Memphis and looking at these properties, or do you have a team out there in place? Like, how are you managing that, being Canadian, living in Toronto?
Yeah, good question. So both. My partner and I were both Canadians. He'd actually moved down there full-time early last year, set up a team, brought in property management. And of course, there's two schools of thought. You can hire property management or you can build the infrastructure. Given that we bought a couple hundred units, we thought it was easier just to build that into it, build it into the formula ourselves. And as far as the opportunity, to me, it was one of those things where even during COVID, it was like, okay, how do I get on a plane? Like, how do I do this? Because we, like the building we bought last year, when you and I had talked a few months before then, but after that, I bought a building. It was 82 units, and we paid about $1.6 million for it, for 82 units.
That's pretty good. That's pretty good. Now, what kind of, just out of curiosity, like what kind of rent, for something that's that big at that price, like per unit, are you getting?
Yeah. So when we bought it, we had built into our pro forma rents for 2-bed, 1-baths at $595, and we're actually getting over $700 now that the units are finished and being rented. So the way I looked at the math, using the Burr model and the thought process of being able to refinance, I thought to myself, okay, $20,000 a door. I get $600 a month rent. That's $7,200. So my GRM, gross rent multiplier, was like 3. So I did the math a few times, because 3 is not a number that you get in Canada. It's usually 13 or 130 or whatever.
Yeah.
Whatever it is. So, the gross rent is really high relative to the purchase price. And at the end of the day, if I had to put that building up from scratch, I had it quoted without the land, and it was, I think, $85,000 a door. So I'm buying for 20 a door. I'm probably spending about 10 or 15 a door for renos on the high end. And, you've got a unit that fully finished, $600-700 a month rent.
Wow. That's pretty good. So so let's talk about that building. So that's 80, you said 83 units, right?
Yes. 82.
Wait, and you purchased that when exactly?
We bought that in, we went firm on it. I think it was, I forget the exact month, but it was Q2 of 2020.
Okay, so
Q2,
Q2 20.
Q2, Q3, beginning of Q3, I think.
Okay, so
End of
during
Q3.
the pandemic, during the
Oh yeah.
closures, all of that stuff. So let's take a look at it. So obviously you found a really good deal. How did you come across that deal?
We had a deal fall apart. It was mismanaged before. So the guy that bought it, um, he, rather than renovating, so it's 6 buildings, 6 smaller buildings composed of anywhere from 12 to 16 units a building. And rather than fix each building and stabilize it, I don't know why this guy did this. He emptied the entire building and then started renovating. So when his financing partner found out what he did, he
Probably
had a
lost his
problem.
mind.
He had a problem with it. Yes. He wasn't paying trades. It was a mismanaged building. We got it privately through our network, basically. And, you know, if you want to do the quick math on it, so we paid 1.6, we'll probably be $1 million into renos. That's 2.6. When it's stabilized with 90 and 90, so 90 days occupied at 90%, we'll have agency financing there. And the value will be at about $4.5 to $5 million at a 7 cap. So essentially, we're going to be able to refinance, pull, you know, everything plus probably a couple $100,000 out, and you've got a cash flow asset for life.
Absolutely. So, okay. So just like, there's a lot of people that are like, you know, their goal is to buy something of that size. So I really want to see how much granular we can get. So you found it. It was obviously mismanaged. You closed on it. How did you close on it? What kind of financing did you get?
Sure. So we put in, we assumed the vendor financing that he had at the time. So when he went rogue with his existing lender, we took over the loan. And we had to put in an additional, I think it was about $500,000 USD, just to close on it. And then we had to fund the renos with cash.
Okay. All right. And now are you bringing in investors or are you using your own money for this to fund the renos and to fund the rest of the down payment, or essentially to close money to close?
Yeah. So a little bit of both. I mean, I have a bunch of guys that always want to do what I do with me. Guys that have, you know, guys and gals that I've known for quite a while. So typically, you know, we like to share the risk. As long as I'm in the deal, they're in the deal kind of thing. And yeah, we all threw in some cash, a couple $100,000 a piece, and funded the acquisition, funded the renos, and then when we refinance, we'll obviously have our, you know, pro rata share. Yeah.
Awesome. So you're doing it with a vendor, so a vendor take back essentially, or seller financing or whatnot, whatever was in place prior. Let's just say whatever was in place prior was the financing that you got. Yeah. And then you are going to go to a US financial institution then to get the refinance. Is that the plan?
Yeah, actually, so one more step before that, Sarah, we actually had, and this is one of the beautiful things about certain markets when we decided to go to Tennessee, they have a program called a pilot program, which is a payment in lieu of taxes. So they have the ability for you to freeze the property taxes on a property that is in complete disrepair. And as long as you bring that property back to, you know, a functional state, and bring revenues back into the community and tenants and provide housing, the city will actually allow you to keep your property taxes frozen. So
very cool.
That was a big deal. We applied for that. That's a 10-year property tax freeze as well.
Wow.
So
and just out of curiosity, like if you didn't do that, how much would the taxes be on something like that?
They would be about 60,000. Right now they're about 10.
Okay. All right. So it definitely is a nice, you know, a nice number there that you don't have to worry about for a while. And what about the landlord rules or the tenant rules out that way? You know, are you able to get people out to do renos? Are you able to increase rents as you need? How does that work out that way?
Yeah, that's actually a really good question, because there's some states in the US where you are SOL, you can't do anything. Right. Tennessee is very much like Texas, like Florida and a few other states where, you know, you have the ability to, it's landlord friendly. So obviously you're not going to do anything pernicious with your tenants, but you want to make sure that they have the ability to, you know, continue to pay to live there and obviously not be a burden on the community.
Absolutely. And then just in terms of like splitting utilities or that kind of stuff, like I know sometimes in the end, I don't know, how much detail we can go through, but I think it's just really interesting to sometimes have these podcasts where we
Yeah.
can dissect something. But in terms of, like, for example, in Ontario, when we assume tenants, like let's just say you've got a building and you're assuming tenants, if the tenants are already paying, a total that includes utilities, you can't split it and be like, oh, now you're paying utilities and you're paying that separately. How is it working for you guys? And are you doing anything different, as you're turning over this building?
Yeah, so we're fortunate because this building, actually, it's interesting. In addition to the utilities on the electric already being split in the building, all the units, I don't know if this is a Tennessee thing, because I'd never seen this anywhere else, but every unit has two front doors. So one through the kitchen and one through the living room. And, we had to insulate, obviously, and I was just thinking about that, but the utilities are separated. The only exception to that when we bought it were the water meters. But what we did with that is we actually, and this is actually a really good tip for some of your listeners, if you're buying a building of any size, even 2 units or more, you got to see how the water main valves are set up, because older buildings like this building that we bought had one water main valve turn off for the entire building.
Wow.
So it was 82 units on one on one line. So, it cost us a couple of bucks, but we dredged in front of every building and we sectioned it off. I don't think we did it per unit, but we did it per 4 doors to make sure that we can manage. And we also put little sensors in our in the little water main valves to make sure that when there's water, we know which of the 4 units in that entire quadrant is the culprit. Because fire isn't your worst enemy. Water is. Water is worse. Fire, you can see, you can smell it. Water, it might take a minute.
That's a great tip. Thanks for sharing that. So you've got, a bunch of tenants, you're turning them over, you're renovating the units, you're putting, a few thousand in to lift it and re-rent it at a higher amount. What kind of tenant profile are you going after? Are you doing any like section 8 tenants? Or are you doing, catering to certain ones over another? Or are you just kind of seeing what's out there, out that way?
Yeah, so Section 8 housing is something that we've looked at. We did get approved for it because it is a program. Because the housing, as your audience probably knows, there's Class A, B, and C housing. And in the US in particular, the C housing is segregated into, I'd say, 2 sections. One is the Section 8 housing and one is workforce housing. And workforce is, it's not subsidized by the government and it's not a charity case. It's not all it is it's clean, safe, affordable housing, but you typically don't have the bells and whistles. Like you don't put a swimming pool there. You typically don't have the higher end finishes in the units. You typically have laminate. You don't have hardwood. You don't have stainless steel appliances. But so to answer your question, our tenant profile is the typical Amazon worker that makes between $15 and $18 an hour. Maybe somebody that works at FedEx. Maybe a nurse's aide, somebody that works for the city in sanitation, people that are starting out, younger families. Our rents, 2 beds, 1 baths are coming in at, like I said, $700. The next step above that, if you want to stay in multifamily, is Class B, and you're closer to $1,000. And then Class A, you're $1,200, $1,600. So, where we're at is we're essentially providing people clean, safe, and affordable housing, which they need. Now, we still run credit checks. We still look at the criminal record checks, because we are running, a community.
And in the US, you're allowed to do the criminal record check.
Yes. Yes. You're also allowed to do, I'm not sure if this is ubiquitous across the country, but you can do sex offender checks as well. So, we obviously want to incorporate that as well. Just make sure you have a good community, because, people that have certain, I'm not here to debate people's history, but at the end of the day, if a mom goes online and checks the proximity of where certain people live, I'd rather that proximity not be in my building.
Yeah, no, that's a good point. I mean, I would likely do the same as you anyways. You might as well create that feel of, security and safety.
Yeah. So the first thing we did when we bought it, I'll share this with you, is because perception is reality with your tenants. And when we bought this property, I don't have any images here, but the front gate was non-existent. It was this big driveway, and you could literally drive a bus one lane and the other lane. First thing we did is we put up a 10-foot wrought iron gate right across the front, and then we patched it up with chain link as it went around the outside. We had fobs for keyless entry. So that package cost us, I think we paid for it before iron doubled in price. So I think we made money on the gate, actually, if I think about it. But if we melted it now, but that perception as you pull up to the property is that this is a safe place to live, and that's really important.
Yeah, especially to attract the tenants that you want. Now, what is an average vacancy rate out that way? I mean, sometimes you look at the US and it's not as crazy in terms of a shortage of opportunities as, places in Ontario as for example. So I don't think it's 2%, but what are you seeing is the average vacancy rates out in Memphis?
So on paper, and I say on paper because we certainly haven't experienced this, but on paper, it's about 4 to 5%.
Okay, so
And that's, yeah, but I can tell you on the affordable side with the Class B or C housing, workforce housing, I don't know if there's any vacancy at all. I mean, my partner and we were at IHOP last time I was there. We were just sitting, shooting the breeze, and the waiter walks by and he goes, "Wait, are you guys doing that property down the street?" We're like, "Yeah." He goes, "Okay, great. My wife and I were," and he just starts pitching us on why he'd be a great tenant. I mean,
oh, nice.
And that's, I think we got his application, but the point is that's a good problem to have, and it demonstrates demand. And I mean, that guy could probably go out and pay $900 or $1,000, but if they can pay $700 and put away $200-300, that's a good deal.
Yeah, for sure. I mean, and you put good tenants in there, ones that aren't going to be, prone to causing problems. And I think it's just easier. So obviously with a big building like that or multiple, like larger options and larger units, you really have to be buttoned up in management and having a team likely on the spot there physically. I don't know how many hours or if they live there, but how are you setting that up with so many units?
So it's interesting because after we bought the 82 units, we got to know there's 4 buildings in the area owned by 3 different people. And we got to know one of them really well. And wouldn't you know it, he was tired of being an active real estate investor. So guy had made a ton of money in real estate, knew what he had, didn't want to finish what he had going on in his property. And we actually ended up buying his property too. So it was 178 units. Nice. And literally across the street from ours. So what we've done is we've actually cross-purposed our property management from our property to their property, retained some of his people and the contractors. And to your point, Sarah, now we have one property manager for all 260 doors, literally right across the street from each other. And we consciously decided to bring all of that in-house.
Yeah, that makes sense. So for somebody that's, thinking about how to do that, like who is it that you're bringing in-house? How many people do you need? And I don't know if you have like a list of a few people that you can share that you're like, these are the people that we had to hire for this many buildings.
Yeah, so it depends on where you're buying in the real estate cycle. So for example, we're not a developer, but we're also not buying turnkey. We're kind of in between. We're that value add player. So there's a different skill set that you need when you're doing value add compared to just buying turnkey. Because if you buy turnkey, chances are you're buying at full market, and it's going to be really hard to burr something or create an infinite cash flow deal, as I like to call it, when you're buying something that's already turnkey because it's already priced to perfection.
Yeah. And you've got to have deep pockets to be able to say, you're okay with leaving a chunk of money in there that you can't refinance for a very, very long time. So, turnkey, I mean, again, there's some investors that, that's what they look for, but, I agree with you, Marcin. I like the value add. I like the BRRRR option and being able to, reutilize the equity or the money that's created for the next deal.
Yeah. Well, and Sarah, to your point, as I get older and I start to accumulate some of the grays in my in my hair here. The turnkey stuff is looking more and more attractive because it's still work. I mean, look, turning a unit over and getting $50 or $75 or picking up $100 on the rent is still valuable. There's still great ways to do it that way. But that middle piece, that value add is really where you create that, lowest, in my opinion, lowest risk versus best return.
Yeah.
So as far as people that you need on your team, I mean, aside from the obvious resident manager, community manager, essentially your on-site property manager. And when you have that many units, and this is my bias now, I don't think you can have somebody in an office that just comes out whenever there's an issue. I'm more of a hands-on guy, and I would prefer my resident manager to be on site 9 to 5, Monday to Friday, and you have your list of people that can show up literally in an instant when there's a flood, when there's whatever it is, because the most expensive thing, and you know this, the most expensive thing is tenant turnover, because when you have that unit vacant, first of all, you lose rent, you probably have to replace the carpet, you might have some other damages to the property, you now have to waste people's time to go show the unit, and it's not really just a month, it's so much more than that month. To clean up that unit.
So I will agree with you, but I will also disagree with you. It depends. I think it really depends on where you are investing. So like if you're investing in a spot where you can increase rents as needed to market rents, absolutely. Tenant turnover, you probably don't want. For a place in Ontario, I mean, if you've got a tenant that's been there for 10 years and or like 5 years even, and sometimes even 3 years, and they're like, hey, I'm going to give my notice to get out. Like I have a party because I'm so excited. I don't mind paying the grand to fix things and turn things around or whatever the cost is, because I know that as soon as they leave, I'm increasing that rent $300, $400, $500, $600 a month, and I'll get it back in no time.
So you're right in that context. I'm more thinking along the lines of when my lease comes up, and if it's going from 625 to 645, that's already built in. And because of the tenant laws, that's already part of the formula. But in your case, yeah, you're right. If the tenant moves out after 10 years.
It depends where you're investing, right? I think that's why like some of the US investing makes sense, because you can increase rents to market every single year of what you need, and you don't have those restrictions like some other markets. So it really is dependent on market for sure.
Yeah. Well, the other thing too is, for anybody listening here, I mean, raising rents to market is not something that's evil or to be frowned upon. I mean, you have to look at it. It's a business. It's a two-way street. And I mean, we've actually had tenants in past deals that I've done where they live on site and they've actually offered to be groundskeepers. They've offered to help. They've offered to do things. So there's all kinds of ways that you can work with your tenants. But at the end of the day, if the market is X, then that's what it should be, because you need to be compensated to actually keep the property in good working order. That's what it should be.
Yeah, absolutely. So you've got a team in place. So what is your role? So you mentioned a partner, your partner is over there, more feet on the street. You're here, what are each of your roles and how do you divide all of that?
That's a good question. So his is very much a boots on the ground role, day to day, looking at new opportunities, looking at deals from a sort of 30,000 foot view, how it fits the portfolio, making sure that the day-to-day operations are solid. I'm on the capital side and the finance side. I'm more than happy to be parachuted and in the trenches doing that, but he's already got a great handle of that. So my role is to go out, identify opportunities to either recapitalize the business, work with investment partners, financing partners. I have a private equity background, so that's sort of where I've spent my history. And the other thing is that working with getting, tax assessments or getting the bond programs, communications, building the infrastructure, the culture internally. There's a business, real estate is a business. And I know you know that, Sarah. So you can't just have a really good real estate guy any more than you can have a really good business guy. You need to have the business behind what people think the business actually is.
Yeah, absolutely. I mean, it sounds like you guys complement each other, right? So you're not both doing the exact same things. You're doing a lot more of the organizing, finances, organizing that kind of stuff, and he's feet on the street. But I think that's important to not be both doing the exact same thing, but to see what makes sense for each person to do, so that you can split the tasks.
Well, the other thing that's important to acknowledge is that on the syndication side, which effectively is what we're doing, we're syndicating larger projects. There's really two components of it, and they don't have to be mutually exclusive. And what I mean by that is operators. So the general partner typically is composed of operations and capital. And the thing is you want to have every transaction set up as its own transaction, because at the end of the day, if one day he gets hit by a bus or I get hit by a bus, every deal is its own transaction. So every time we buy a building, we set up a new company, we split the work, and we move forward. And maybe one day we decide, you know what, we've had enough in Memphis, or we've had enough of each other, or we've had enough, just whatever it is. At the end of the day, every building is its own asset, and that's really important to differentiate, because if you're ever bringing on investment partners, they need to see the separation of where their involvement in what you're doing is limited to, because that's important as well.
Yeah, absolutely. And you mentioned syndication, and I can't remember, I think we might have covered it a little bit the first time that you came on. But if somebody is wondering what is syndicate, what is a syndication, what does that mean, and how you set that up, are you able to just give us a bit of an overview on that?
Sure. Syndicating a real estate transaction means different things in different countries, but essentially it's the act of doing a deal that requires more capital than you personally have. And if you have, or than you're personally willing to put into one transaction. So for example, my favorite structure is a limited partner, general partner, LPGP structure. And we did that in such a way where we were able to separate the Canadian investors from any potential US investors. And from a Canadian investor standpoint, have no tax filing requirements on the US side. So they have exposure to US assets. They have no US tax filing obligations, which is a very big deal for somebody who's never filed with the IRS. They don't want to start, right? But syndication, I work with lawyers, I work with accountants. There's rules to it. It's a highly regulated space, but if someone is committed enough to learning it, you can learn it. But like anything else, it's going to take a minute.
Yeah, absolutely. So it sounds like you've got, money partners that invest their money into a big fund, and then you take that cash and you deploy it into, whether it's the acquisition of a project or the renovations of a project and all that stuff. So are you giving them we don't need to talk about return numbers, but are you giving them a return, or are you giving them like an equity share of the profits? How are you doing that?
You sound like my lawyer now.
Well, you know what? We don't dissect deals very often, but I think it's going to be very interesting for somebody listening.
Yeah.
How it all gets pieced together.
So, this goes, I don't know if we're going to be able to do it justice on just, 30-minute call here, but ultimately you need to look at a transaction from an investor standpoint. What's in it for them? And, it's interesting because I do some coaching with some real estate guys that, have a building or two and want to learn how to raise their next million or $5 million. And so few of them think about it from the investor's perspective. They're just thinking about, okay, I got to do this deal. I got to get done. Okay, who wants to invest? And then people are just like, there's no expectations. There's no clear format. So to answer your question, Sarah, this is my opinion. In my opinion, any investor that's going to invest in a syndicated real estate offering should be able to generate, there should be a reasonable expectation that they're going to generate double-digit returns per annum. Now, they may not get that all at once. They might get it on the refinance or on the sale. But personally, I wouldn't do a transaction unless I thought an investor, myself as well, would have a reasonable chance to make good double-digit returns. Is it 12%? Is it 20%? It's deal by deal. There's so many variables. But at the end of the day, if you start with, okay, what is the expectation for return for the investor, and you have a number in your head, let's say it's 15%. Then what you do is you work that backwards and you think to yourself, how do I get to 15% for the investor? Is it going to be a split on the back end? Is it going to be some kind of a high watermark up front? I call it a preferred return. How do we do it? In my case, from private equity, what I've seen is that typically what people do is they build in what's called a preferred return. And it could be anywhere from 4 to maybe 6, 7%. And that's an annual preferred return that's accrued for the money. So whether you put in money, whoever puts in the money, they automatically accrue that up front first. It doesn't matter. It doesn't mean it's being paid out because maybe there's no cash flow yet because you're renovating or whatever, but that accrues and for the money. And then after you account for that, and whether you pay it out or continue to accrue it, beyond that, there should be a split. Now, I've seen splits as much as 60-40 for the managing partners and 40% for the investors. And I've seen it all the way where it's 80% for the investors and 20% for the managing partners. So, somewhere in between is probably right. If you have a deal where the investor gets everything and the managers don't get anything, eventually they're just going to say, screw it. Like I'm not incentivized to work. Yeah. But at the same time, I don't know how I would feel about taking the bulk of the profit, as a partner compared to my investor getting less. So, somewhere in between is probably the right answer. And, if you combine the profit and the preferred return, without you using optimistic numbers as the syndicator, because that's another thing, I know when I started in real estate, I would sit there and I'd go, these numbers suck. What if I increase the rent by $200? And then all of a sudden it looks amazing, right? But you're lying to yourself, right? So as long as you're using reasonable numbers and it all flows through and with your splits, it looks like the investor is getting a great return and you're using fair assumptions for, all the different components, then, that's a good place to start because smart investors are going to expect you to walk them through your logic.
Absolutely. Well, thanks for sharing that. That was awesome. Mm-hmm. Before we get into our lightning round, just curious, what's next for you? I mean, you're working on all of these things. Are you continuing to look and are you continuing to acquire? Or are you really focusing on these 2 large deals at this point in time?
Yeah. So, we've got our eyes out. We might look at doing one more acquisition at some point this year. It's, still got a few months here in in the year here. So we might end up looking at another acquisition, probably comparable size. The other thing too, that I've actually started doing a fair bit, and I'm enjoying it, is working with some of the, real estate friends that I have. I've started doing I've never done the coaching thing before, but I've always kind of done it. So I'm kind of doing some of that with people that one guy's got a couple hundred doors. He's trying to figure out how to take that to the next level. Another person has 20 doors. So I'm doing a fair bit of that. COVID is obviously keeping me at home. So anytime I can talk to people and they want to listen, that's nice. Just keep doing more real estate, keep helping people out. And started doing, trainings on a monthly basis and people can check that out on my website. And I think we're just going to keep doing more of that.
Awesome. That sounds great. All right. So Marcin, we're going to do the lightning round. Your questions that you probably answered them a couple years ago, but maybe your answers have changed. So are you ready to play the lightning round?
Let's do it.
All right. So question number 1, what is your favorite real estate investing book?
Ooh, there's a lot of real estate books. Can I give you my favorite book right now? Just in general?
In general, yeah, let's do it.
I'm reading a book I just actually finished a book called Relentless by Tim Grover. And he was the guy who was the coach to Kobe and Michael Jordan. And for me, I needed that book because sitting at home, I was, let's just say some of my physical habits were not in line with my mental habits.
Awesome. All right, cool. Well, I'll have to check out that book. Now, I don't know if you're a podcast listener, but question number 2, it doesn't have to be real estate related. Do you have a favorite podcast?
Oh man. You know what? I'm listening to, I don't know if I have a favorite, but I'm absorbing a lot of macroeconomic financial theory stuff with what's going on with all the printing money and the inflation. George Gammon is somebody I'm listening to a lot right now, Peter Schiff. And then I also look at the other side, like I'm listening to Bernie Sanders and like, I want to hear the extreme one way and the extreme other way, because nowadays there's just so much going on out there that I'm kind of listening to all kinds of far right and far left stuff right now. Well, not far right, but you know what I mean? Like
it's important to balance out the conversation, right? We can't believe everything that we hear from the radio or the news. So we've got to, listen to both sides.
Well, that's one thing I'm definitely not doing. I'm not watching the news in Canada. I am not interested.
Don't do it. It's an instant mood changer for the worst.
Yeah.
Question number 3. What do you do for fun aside from work in real estate?
I am doing push-ups.
I don't know if that's considered fun, but sure.
No. Just hear me out, okay?
Sure.
I've been at home because I used to go to the gym like everyone else all the time, and then you stop going to the gym. So it was pointed out to me that I was getting soft in certain areas. So so what's fun now, or at least I'm brainwashing myself into telling myself it's fun, is I'm learning how to work out at home with like furniture and the dog and like all kinds of stuff. So
cool. Awesome. Question number 4. If you lost all of your assets and all of your money tomorrow, how would you start again?
Oh, that's a good one. You did ask me that one before. What did I tell you? You know what I would do is I would find the people, I would find people that I can make rich and go make them rich. Because at the end of the day, there's certain people that I know I can help. And anybody who's in real estate, anybody who's got a skill set, I would literally be able to take those people and find ways to make them rich. Like I got started in real estate by collecting for sale signs when I was 19 for a realtor. That's how I got my foot in the door. Like I had no business, no family, no contacts in real estate. So I just literally went to work for free. And I'd probably go do that again. I'd find somebody who's making a ton of money, go make myself useful, work for free, and pretty quickly figure out how to capitalize on that.
Awesome. And I don't know if I knew that that's how you got started, but that's cool.
Mm-hmm.
Okay, awesome. And last question, if somebody has $50,000, and I'm thinking one day I'm gonna have to raise it because of inflation and all the money that we're printing, but if somebody has $50,000 today, how would you recommend that they spend it to get started?
No, you're right. 50,000 seems to mean a little bit less now than.
I feel like when I first started this show, it was still.
Yeah,
it felt like more.
It's funny. So I grew up in communist Poland, and my grandma once gave me a $10,000 bill back in the late '80s to go to the grocery store. I thought I was rich. $10,000 because they debased the dollar so hard. I think I got a few lollipops and a bag of chips. And that was 10,000. And then when they finally rolled the Polish dollar back it was called remuneration. It was literally a remuneration of 10,000 to 1. That's what happened. It was, but anyway, $50,000. Let's assume you can, do stuff with it.
Let's say Canadian dollars, 50 Canadian dollars.
Okay, 50,000 Canadian dollars. So, 50 grand in of itself is not going to allow you to retire as a passive investor. I mean, you can invest 50 grand, and even if you get, 10% on your money or 20% on your money, that's 5 or 10 grand a year. That's not enough for you to, retire or really plan your life around. So $50,000, I would take that money and I would definitely invest it in an asset, but also get an education. So what I mean by that is if you're going to invest 50 grand in real estate, do it with somebody that you can learn from, somebody you can work with, somebody you can partner with, somebody that, yes, you've got 50 grand invested in an asset and part of an apartment building, part of a house, part of a cottage, whatever it is, but you're also working on that deal. So you develop a skill set. That's what I would do.
Awesome. Great answers. Marcin, where can my listeners reach out and find out more about you?
Best place is my website, marcindrozdz.com. And I'm on all the Instagrams and Facebooks and all the different stuff. And if people, I've got tons of content and videos and webinars that people can attend if they want to learn. Check us out.
Amazing. Thank you, Marcin, for being on the show. It was a pleasure having you back again. And congrats on your 2 very large acquisitions. That's awesome.
Thank you. Really appreciate it.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?